Hello everyone, welcome to a new video. Today I will be analyzing the company Walgreens Boots Alliance to see if it could be a potentially good investment to make at the moment. In fact, I can already tell you that I currently own 19 shares of this company with a total current value of around 660 euros. And I recommend that you watch the video if you are interested, of course, in the company and investing in the stock market, because I will basically be summarizing all the information, or at least all the information that I could find out there on the internet, in hopefully less than 10 minutes. And let me tell you as well that I probably have spent 1 hour, if not more, just doing research on the company and everything, which basically means that if I'm making a video of 10 minutes and I research 1 hour, I'm basically saving you 50 minutes of your time by you watching this video. Therefore, if you find this video useful, I hope that by the end of the video I can earn your thumbs up. The way this video will be distributed will be: first, I will give a brief introduction on the company and some general figures. Secondly, we'll be going to the financials and other metrics. And thirdly, I will be giving you my opinion and what I'm planning on doing with this stock in the future. To begin with, Walgreens Boots Alliance is a company within the pharmaceutical industry. It has more than 18,750 retail stores distributed throughout 11 different countries, although I must say that most of them are located in the US. More concretely, 49.48% of the stores are, as I said, located just in the US. If we check their international locations, we see that their presence has been much lower, with only 4,605 retail stores. Not only it has retail stores, but it also acts as a wholesaler and distributor of medicines and other health products throughout more than 240,000 locations, including hospitals, doctors, medical centers, among others. Something that I also find interesting about the company is that it also has holdings in other pharmaceutical companies, not only in the US, but also in countries such as China. Specifically, I mentioned this one because I find it very interesting since, as you probably know, China is a very powerful economy. These companies are Guangzhou Pharmaceutical Corporation, Nanjing Pharmaceutical Company Limited, and Sinopharm Holding Guoda Drugstores. And I want to remark that these are not all the holdings that they have that you can check in their website, but these were the ones that I found more interesting. In terms of the stock itself, it has been trading in the stock market since 1927. And at the moment, its shares are trading at roughly $40 per share. Its ticker symbol is WBA, and at its current price, its dividend yield is 4.56% with a payout ratio of 48%, which, considering the current situation, I would say that it's pretty low. Moreover, it is a dividend aristocrat and has been growing its dividends for 44 years in a row. In fact, just recently they announced that they would be increasing the dividend payout by 2.2%. All of these that I just mentioned, for a dividend investor like me, sounds very good. Nevertheless, if we look at its graph, we see that although throughout time it has been growing consistently, in the past few years the stock price has been decreasing. Seeing this, let's actually go and see the numbers to see whether this decrease in price is justified or not. Since the results of the second quarter of 2020 have just been released, we have fresh information on how the company is doing at the moment. Looking at the balance sheet, we see that it has a debt ratio of 75%. Which can be considered relatively conservative for the business model of the company, although in general terms it already starts to be a bit high. In terms of cash and cash flow, we see that the company is generating a lot of cash from its operations, and even more than last year. Furthermore, it is still holding $943 million in cash. In my opinion, they are a very safe company to invest at the moment. Not only they are in a very defensive sector, which is the pharmaceutical industry, but also they are able to generate cash relatively easy, even with the current crisis. Because comparing it, for instance, with the airline sectors, the airlines are not selling tickets, and therefore they have big problems in terms of cash flow, because they are not able to generate cash to support their current activity, which is almost nothing, and just maybe paying for the employees and all the planes and the maintenance and so on. If we now look at the income statement of the quarter, we see that it does not look so good, and this is the main reason why the stock dropped 10% after publishing its results. We have that in this quarter they have had a net loss of $1,708 million, while on the previous year they had made a profit of $1,025 million. This is a big difference, but let's see what happened really and why this happened. We see that the sales increased in this quarter with respect to the last one, which means that the company is growing. And we can see that the main reason for the negative net profit that they reported for the quarter was the non-cash impairment charges of 2 billion in Boots UK. And this thing of non-cash impairment charges just basically means that the company, this Boots UK, is now basically worth less than what it was maybe when they bought it or when they started, investing in that, and they are just deducting that from the current value of this company. But actually it is not an expense that they have had to pay now all of the sudden. It's something that they already paid years ago. So I don't see this as a very negative thing, because many companies are going through tough times right now with the current corona crisis. Therefore, focusing on the operations in general, I would say that they are doing well. They have managed to increase their sales, and it is true that their operational expenses have increased, but that has been due to the situation and the measures that they have had to implement in the different stores that they own. If we now look at the historical income statements for the past 4 years, we see that they have been quite stable and the company has generated profits every single year. Based on everything I have mentioned right now, I will now give you my honest opinion on the stock itself. The first thing I must say is that I see this company as being clearly undervalued. Considering that it is a very well-established company, that their financials are looking good, and the dividend that they pay, I see it clearly undervalued. In fact, I must say that my average buying price in this stock has been of $40.56, which is more than what it's trading at the moment. And this is because a few months ago I already bought some shares of it, but now I saw that it decreased more and I added more to my portfolio, because I basically, as I already said, see this stock as being undervalued, and I take the chance when it's trading at even more discount. As I already mentioned at the beginning, this stock is currently yielding 4.56% in dividend yield and is a dividend aristocrat that has been paying for 44 years in a row. For me, this is the perfect or almost perfect play if you are a dividend investor, because the company not only offers a high dividend yield at a low payout ratio, but also has an important upside potential in terms of stock price and is a very safe company. Finally, I just want to mention that if this stock goes down in price even more to, let's say, $36, $37 a share, I will add even more to my portfolio. Anyways, I hope you enjoyed the video. I just want to remind you that I'm no financial advisor and that I just share here my thoughts, and that if you would like to invest in this stock, you should do your own research. Nevertheless, as always, make sure to like the video, subscribe to the channel if you're not yet subscribed, and see you next time.